Under radar, we have SBI. So PSU banks have been witnessing very strong earnings traction, which is likely to continue even going ahead. And this would be largely led by robust loan growth, margin stability, and controlled credit cost, which would be driving continuous re-rating in the sector. Now, if we talk about the loan growth, that would be very strongly driven by the overall huge government capex program that is there in the pipeline for next few years. So that would fuel the private capex, which in turn would boom the overall loan growth for the banks, and especially we are bullish on the PSU banks because the loan growth would be much higher for them compared to the private banks. Now, the loan growth for PSU banks, we are expecting roughly in the range of about 25%, while compared to the private banks, we are expecting roughly around 19%. So there's a huge growth potential that is expected for the PSU banks, and the changing narrative with regards to the interest rate may further push their overall earnings profitability and the growth outlook. In fact, the PSU banks are now very well placed to sustainably deliver 1% ROA, which looked aspirational earlier. So, in fact, select PSU banks like SBI, they have guided for 1.2% ROA by FY25, which would imply scope for further earnings upgrade. Now, if we talk about SBI in particular, their loan growth remains very healthy, and we expect about 13% CAGR over next 2 years. The corporate segment has lending opportunity of almost 4.8 trillion, while the SME book is expected to scale up to almost 4 trillion. So the asset quality for the bank also remains very strong, with continuous improvement we're seeing quarter after quarter in the overall headline asset quality ratios. The restructuring book also remains quite under control. So, given this background, we expect SBI to deliver FY25 ROA of 1.1% and ROE of 18.3%. And SBI remains our top pick in the sector. We have a buy rating and a target price of 800. Thank you.